Welcome everyone to Name Confidential Live.
Hey guys, welcome back to another episode of Name Confidential. I'm Branden DuCharme, your host today, joined by my colleague from Name as well, Ryan Redfern, down in Austin, Texas. The Name Exposure Index came in this week. Once again, mildly less bearish than last week, which aligns with the trends of the market, as contrarian as that may sometimes be. Ryan, what a freaking market this week, man. A real he said, she said, if you will, in all the tariff talks. And I don't know, craziness everywhere. Let's talk. I kind of want to spend a little bit of time today, like not talking about the tariff stuff because I think it's so overdone. Everyone's so sick of talking about it. And at the end of the day, like whatever you think your edge is on knowing what the next thing Donald Trump's going to tweet is, it's like you don't have it, it's like you just don't have it. There's some positive news emerging, there's negative news emerging. But in the words of JC Peretz, who was supposed to be joining us today and must have just gotten caught up, is he says, the only thing I trust is the bond market and dogs and maybe price.
Right.
And bonds are moving interesting, and price is always fun because you can spend it.
Yeah. Yeah.
What?
Not sure what wisdom you want to go with.
Yeah. Well, so let's talk about the price action first. Would you rather start with the bond market at all, or would you rather start with equities?
I'm so technical. If you want to go fundamental, I'm like, I don't even know. I mean, I'm like fundamentally, because I was buying 10-year treasuries about 2 weeks ago, and that's finally paying off for me. Even in one of my more aggressive strategies. So yeah. Do I like them? No, I can't. I don't like bonds at all, but they're actually not too hard to trade. But what I found wild a couple weeks ago is 2 days after that, the tariff announcement, all the safest, most boring bank loans, floating rates, all my favorite stuff just got smashed, and it's all climbing back. But that's kind of been my overview of the bond market, trying to reassess where the strength is and what's really happened. And was that just a shock and we're all fine, or is it all going to roll over again? I don't know.
It's hard to know. The price action, I find it to just be interesting in the bond market. It's almost like as of recently, whatever you think the bond market should be doing, it starts to do the opposite, which makes it like tough to trade on a shorter time frame. And in particular, I think like I don't want to be the guy that says like conspiracy theory, manipulation of the bond market or something, but it sure does appear like there was a pain threshold met by the administration, whatever it was 2 weeks ago now, in the bond market, with a 30-year hitting, 5%, which is funny because that's the 10 years been up over, nicked over 5, I think just last year. Right.
Yeah.
So like not that crazy on rates. The 2 years like keeps sinking in yield, suggesting that, it's time for the Fed to cut. And it's just, so it's all over the place, right? Like, and credit spreads had widened, and now they're kind of calming down. You would really expect if defaults were really getting priced in, like credit spreads would be, especially like there'd be huge dislocation in like those bank loans, right? It just doesn't really seem to be there.
No, like, what's something interesting that I had really close to the bottom. I had a client kind of freaking out, one who's, sold a bunch of NVIDIA at the top, and has a good amount of money, but we put in all some short-term bonds and some floating rates and some boring stuff. But he was freaking out because like his thing was other countries are not going to buy our bonds anymore. Therefore the market's going to collapse. And I was like, I'm not really quite getting that as a reason, but I think it's interesting because most of his stuff has bounced back. We told him to stick with it, and he actually did. But he he was surprised about my optimism. I'm like, when things are this bad, you got to go shopping. I mean, you have to. When I'm getting the calls from clients that are freaking out, I'm like, oh, this is good. This is when we go nuts and we get after it. You have to, and it's paid off. It already has. This week is an awesome week.
Yeah. Well, there's so I mean, let's talk about like the rally, right?
Yeah.
S&P 500. Let me switch from looking at SPY to just looking at S&P 500 here. So I'm like using just index levels. I think
Sure.
people tend to track better if you use the index levels. So you have the gap down on what becomes the morning of the third, right? Opens up right at like that 5,500 level, smashes down. It comes up on that big short squeeze day, and that huge rally comes up, almost gets to the 5,500, kind of pulls back, and then on the next rally up a couple days later, it gaps up and then actually sells off throughout the day. And that's on the 14th. Didn't breach a new high. So from a technical perspective, you start having this confirmation, right, of lower lows and lower highs. And now it was this week that all of a sudden you have, it was in intraday. If you're somebody that does intraday stuff, intraday on the 23rd, on Wednesday, yesterday was your confirmation, that you have a new higher high, right? So theoretically a lower, higher low and a higher high, right? And then today is like that close above that 5,500 level, sort of I think from a technical perspective, we call that confirmation. And one of the things that I kind of learned in 2022, and I mean, you're more seasoned than I am, so correct me if I'm wrong here, is like, well, it's like oftentimes when you have these bear market rallies, there's almost this funny phenomenon that like I think happens, which is what right at like all of the signals firing off that like it's time to get long from like an intermediate time frame, right? That almost calls the top of like a bear market rally, in my opinion, right? Like they're like once they start to fire, it's like, and there it is, right? And then it kind of goes, can drop back down. And so, depending on how you look at the price action stuff, like I don't know, are we there? So you have four kind of up days in a row. Is Monday going to pull back? I don't know. But certainly the breach and close above that 5,500 does lead me to believe that the low, that 4,800 low, is probably in. Again, I have no idea for sure, but it's looking good. It's looking certainly better than it was a week ago.
Oh, absolutely, it is. But we're still below the 200, aren't we? I believe.
Yeah, the 200 is up at 57.46.
Yeah, I don't have it on this chart, but yeah, we're still below there. So I mean, you kind of still have to go, okay, is this going to run out of steam at some point? I've got some factors I'm looking at are saying, start trimming pretty soon because I bought a while ago. So I'm happy to start trimming what I bought, and I've gotten what I want out of it. Do I think we're going to hit new high? I don't know. I'm kind of playing this as a bear market rally for now. But you're right. The structure is beautiful. The structure, we're getting new higher highs. We broke that resistance. We're climbing up. We're still below that 200. Surprises still happen in that time frame, or not time frame, in that context, right? The market below that. I mean, going back to Michael Guyad's papers, there's always the biggest days up and down happen below those moving average days. So we're still down there. So I don't love that. If we really break above that, then I'm going to be much more aggressively bullish with leverage.
Well, yeah, I mean, it's like you get up above the 200-day moving average and you got a VIX below 20. It's like you just. Right? We all know what to do.
And speaking of the VIX, one of the things that I got from Larry McMillan, who spoke in Florida at our last conference, using the VIX crossing the 21 EMA, if it crosses below, but it's been bouncing around the crossover was somewhere around 30, and this last couple of weeks it was above, below, and I was like, oh, that's usually a really good signal to go long when that crosses below.
I mean, these type of markets are really hard. They can be really, really hard. And I mean, what's the old saying, right? Like nothing good happens below the 200-day moving average. Who said that? It was a famous old technician.
Sure.
I'd love to give credit to Paul Schatz, but I don't think he's quite old enough for that one.
He's pretty old.
Yeah, I don't know. Like, I feel like that one could have been like invented way.
No, absolutely.
I'll look it up. Uh,
Sure.
anyways, um, do you track the dollar at all though? Like that's one of the things that I found really interesting about this rally.
I do, but more for the context of emerging markets. That's really the thing I use it most for, is to understand what's going on there. Because I
In
love
a,
to short emerging markets. So
okay. Well, I think you and most hedge funds, right?
you gotta go where the easy money is, and that's, for me, that's one of them. Watching the dollar and then watching emerging markets play, do the opposite, and it's like, oh, hey, there's the trade. And I use that as a hedge because I love holding the S&P long term. So I love
Yeah,
to buy something that's going to be weak next to it. Um,
yeah,
that's one of my favorites.
yeah. So okay, so I mean, what has a dollar been sort of telling you this week?
Not too much. I mean, it's falling dollar is good for emerging markets, right? If I recall, but it's starting to reverse, isn't it? I think so. That
Yeah,
might.
yeah. You kind of had a bounce off, but I guess like what I found interesting about it is that you have this ripper. I mean, not really ripper, but I mean it's good rally, right? In
It
U.S.
was.
equities, and part of what was interesting is on the way down, you had like the dollar really selling off as well, which is a little bit funny because right, it's always been sort of perceived that like a weak dollar is good for assets, right?
Yeah, yeah.
Um, not the last couple weeks. It's been great
Nothing
for
always works.
gold.
Yeah.
Still, as people would expect,
Well, didn't gold
but
suffer?
but not for
COVID killed.
equities the same way. And um, but it really the dollar it bounced, but it didn't really. I would say the dollar didn't confirm the rally. Is maybe the way that I'm
No, that's
saying
fair.
it.
That's
I would have really liked to see a bigger move in the dollar to sort of confirm that you have money flowing back into the U.S. markets rather than just pure domestic buyers. Um, supporting the markets. From a global macro perspective, right? Like if you have potential recessionary concerns, I would want to see that there's money, like a lot of money flowing in, particularly globally, into the U.S. markets. Like if we were having that flight to safety trade into the U.S. into the dollar, that would make me feel right. And feels a subjective term. Don't trade feelings, but like that would make me feel a lot better about this rally. It would give me a lot more confidence in it, right? Um,
sure.
so
I mean, it's a context. It's not really a signal. It's just
you're
like a.
right. Yes. Yeah.
It's like, okay, good. The setup is there. Then I start going, well, just look at the chart and what's it telling me to do. And a lot of times it's the opposite, and that's where it kind of sucks, and it's tough. Um, so yeah, I don't know. I mean, I've actually been short the Dow lately in the past couple of weeks,
Really.
while holding other things. Yeah, and I've had days where they both win. The Dow's loses while the S&P makes, and I'm like, hey, it's been working out. I'm actually still up on that, even though the market's been rallying. My Dow short is still, I think, break even, but it makes me happy on the bad days. So,
Yeah. Well, what's the saying? Diversification means there's something in your portfolio you hate.
it's funny. I'm more of a diversification. I think the more garbage you have in your portfolio, the less it does. I try to find what's working and stick to that and dump the stuff that doesn't. That's just been my philosophy.
It is always funny when I look at people's different investment accounts or their allocations and there's like 20, 30 positions,
Right.
and you're like, how do you manage that? I mean, if you're an institutional, you know what I mean? If you got a
Yeah.
whole investment team and everyone's kind of got their thing and it's all coming together into one thing, I suppose. But, like when there's like these Morningstar style box type portfolios and you got like, small cap, mid cap, large cap, and all, every flavor of growth value, middle, and then you got international and
Yep.
developed and emerging markets and emerging market growth and developed market value. And
Yeah.
it's just like, what? And then they get to bonds and then they're like, we got treasuries and high yields and MBS and, short term and long term. And
I
you're like,
love that
oh,
because when those come in, and they usually are given by that advisor that's in every strip mall across America. I could pull that thing apart and show you. We could cut out half of this, and your performance would be way better with less risk. I mean, It's not
Yeah.
hard.
Yeah.
So
The old worsification.
yeah, I'm just not a fan of it. I think you can find a concentration of a handful of things, not just don't go all in on one thing, but you can find like
Yeah.
I'm more in like the 4 or 5
Yeah.
asset classes and like focus on those. Don't be like I have to own every asset class. I think that's stupid. Like when I
Yeah.
get wholesalers going, "Oh, what's in your small cap, slot?" I'm like, "Nothing. It's garbage." So
Inverse, yeah, inverse Russell
inverse, right?
2000 is
Yeah.
in your
You got an inverse
is
for
in
me?
your
Yeah.
small cap stock. I already know that one.
Right. So I mean, I'm just not a fan of that. I think you can do so much better by just paying attention, look at what's working, what has the momentum behind it, and stick to that. And sometimes
Yeah.
it shifts. I mean, one thing that's hard for some investors and advisors to do is to say, "Hey, this overtook," and I usually will stick with what I started with. Like if the S&P is strong with the Nasdaq starts getting stronger, I'll stick with the S&P. I don't want to trade mid cycle or mid trade because I find I tend to make the wrong decision by switching out, right?
Hmm.
Even though it's showing more strength or whatnot, I don't like to swap out until I get a finishing signal on whatever I'm in and whatever I'm trading or buying. So
Yeah. Yeah.
ranty, sorry.
No, you're fine. What other things like do you look at anything else on the fringes of what's the weakness opportunity to take a short in?
My favorites are small cap and emerging markets. I'm in the Dow because I just thought with tariffs that's going to be a harder hit index. In
Hmm.
theory, theoretically, it was a guess. In all honesty, it was a guess, and it's turned out well. But I feel like it was a lucky guess. So don't think I'm like got
What
this skill.
what was the news that came out that pushed that down the other day? Was it when Intel said they were laying off 20% of their something got crushed in the Dow, and there was a big component this week. I'm
Yeah,
trying to
there
remember
was.
what it
I
was.
love that day. I was so happy.
Yeah, it was a real outlier, and it's because the Dow. What's so interesting about the Dow that people forget about now is that all of the major indexes that are tracked nowadays really are all float adjusted, market cap weighted,
Mm.
which turns them into quasi big passive or systematic momentum trades.
Mhm.
And the Dow is not like that at all. It's still,
No.
for whatever godforsaken reason, it is still price capped, price weighted to a basket of 30 stocks picked by the investment committee. That's like, as much as it is an index, it's like the least passive you could probably come up with.
Yeah,
And so I think that makes it somewhat susceptible to, in particular, these shocks sometimes.
yeah.
Um,
But
I
there are also times where it's just fantastic. There are times where I love it over the S&P and over Nasdaq.
Yeah,
Like 2022 was the great place to be.
yeah, I know. Like Ben Rapon, he trades and he uses he trades between growth and value,
Oh yeah.
depending on what he thinks is in favor, and he
Yep.
uses the Dow as his like proxy for value, and the Nasdaq 100 as his proxy for growth.
Okay.
It was like it's his thing, right? But like there can be some pretty big discrepancies. Like earlier this year, it was quite significant, right? Like the Dow really outperformed um, the Nasdaq earlier in the year. So it'll be interesting. Yeah, if this, if the bottom's in and you're starting the rally from a cycle, like kind of cyclical rotation standpoint, I mean, the right things are leading, you know, like I remember in 23, like this is what so JC was supposed to come on today because I listen to JC, like sometimes I listen to his morning show every once in a while or whatever.
Mhm.
And he talks about like when he came to the NAIM conference in Scottsdale,
Yeah.
and he talks about it when he's like I asked if it was a bull market and like no one raised their hand, and I'm like, well, like I don't know if you've ever been to one of these conferences, but no one likes to raise their hand for anything. Uh,
It's
you
true.
could have asked people if it was like the sky was blue. Like people don't always like to just raise their hand,
Yeah.
but he rags on us. And I was there, and so I messaged him. I was like, yeah, I was in the crowd, man, and like I didn't raise my hand. I was admittedly too bearish too long in 23, and the summer sell off before the big rally in the fall. Like I did catch that, and it really kind of made all the difference.
Mhm.
But for me personally. But what I learned was, okay, so if a bull market is getting going, it's okay that 7 stocks lead. Like you know what I mean? Like someone's got to lead the rally, and expecting everything to lead the rally is not like realistic. Unless maybe, I don't know, unless the printer gets turned on, in which case, you know, max long full leverage. I think is maybe the potential idea there. But
you're right in that though. I mean, and even back to Bender-Pond's ratio of NASDAQ to Dow. I mean, if tech is the leader, that's where the growth is in the market and the economy. If that's leading, then we're in a good market. Even Rob Hanna, Quantifiable Edges, does some great work showing if the NASDAQ is weaker than the S&P, you don't want to be in either, right? We're usually going to be in a market where you don't want to be invested in much, or pick your shots and kind of go for it. And that still kind of references back to the 200-day or 100-day moving average. When you're below that, you just got to go for it in little bits. When it's above and when the NASDAQ's leading, just go all in. There's no reason not to be all invested. Let the ride the leaders. It's a gift. It's easy, like it was in this 2023, 24 for the most part. It's Nvidia and tech. Nothing else.
Yeah.
Semiconductors.
Well, like was in 23, you had it like tech really led,
Mm-hmm.
and you even had that like further breadth deterioration under the surface. Like everything that wasn't that was still like getting worse, and deepening in their own bear markets respectively, I suppose.
Mm-hmm.
And then all of a sudden in 24, you have like tech. I mean, tech did well, but there was a point in the year where, really was kind of just trading somewhat sideways, and then the rest of the market really expanded out and caught up and made for, if you were in the broad market, it felt like a relatively smooth ride. Like 24 was relatively low vol, and
there were a couple good shocks in
relatively
October,
relatively good returns. A couple instances of discomfort in 24.
Yeah, they were good shocks though. They were surprisingly big. Certainly, if you were concentrated in tech, that's what I found. Because this July one hit me a little bit harder than I would have liked, and I was ready for the next one, and that was less painful.
Yeah,
And then you go back to the ratios. Value started beating growth at the end of 21, somewhere in October, November, where you had value beating growth on a bigger scale. Something that I look at is the value growth ratio, and that was kind of like the precursor to a terrible. Like 14 months, basically. That really, it's a good tell. If you see value over growth, you see Dow over tech, over NASDAQ. Mm-hmm. Those are good signals, or good context to be paying attention to. So we're in a place where you got to pick your shots and not be too crazy.
Well, yeah, that's the old, when it's something I learned from, oh man, how am I forgetting his name right now? He's from Idaho. All hat, no cattle.
John McClure.
John McClure. Yeah,
John McClure's great. Yeah.
Great guy. But he I remember him just telling me, like, look, volatility is leverage.
Mm-hmm.
Okay. So when volatility picks up, you cut position size.
Yeah, absolutely.
You try to trade less, have less exposure. And what that plays out is like, I remember somebody saying, like, could the VIX really go to, like, I don't know what the numbers. I know how to do the math if I cared to, but it's like, could the VIX really go to, like, I don't know, it's like 70 or 80 or something, right? And someone was like, no, that would imply a daily move of 7%. And I was like, oh, so like what we've had for realized volatility the last 3 days in a row. I'm like, what? Like the craziest part about this whole like market the last couple of weeks is that implied vol has been trading at a really big discount to realized vol.
Mm-hmm.
That's I'm not an options, I'm like not a big options trader or something, but I bet you if you are, I would think there's probably some kind of pretty big edge to be had in something like that.
Certainly.
But it's uncommon, right? That the options markets pricing in, they're selling you volatility expectations cheaper than what has just been realized and kind of sustained for an uncomfortable amount of time, right? It's been pretty big moves. So it's like the market right now is like the last couple of days. It's like, oh, it's oh, it's only up like, oh, it's down 40 basis points and now it's up 60 basis points. I'm like, this is boring.
Well, I know. Yeah. When you have those days, you're like, we're only down 1%. What? Oh, that's nothing.
Yeah. Yeah. You get to
Wild.
completely desensitized to it.
Yeah.
Um,
No, but you're right about the VIX though. I mean, the forward VIX is not as bad as the current VIX. Looking at the contango versus backwardation, the fear is now, and it's not too much in the future. So I also think it's kind of a suggestion that this should calm down a little bit, at least for the next 90 days, as they someone said.
I think we got something like 70,
Yeah, exactly. It's
73
sub
days
90,
or
but
something.
yeah,
I think we're like what are we? We're like 13 days into that or something.
Yeah, right.
They
Exactly.
made that announcement on the 9th, the 25th. So
Yeah.
what is that? 14 days in? No, I'm doing my math way wrong here.
80, 75, somewhere around the 75. Yeah.
Whatever. Yeah, it's
know
like,
what I meant. It's a context thing,
well,
right?
what's interesting about the marketing, like the market taking that whole thing is that, I don't know. I started this with saying, like, I don't really care to talk about the kind of macro politics out of it, but
Sure.
like, through a purely macro lens, disregarding price, technical setups, everything, and just pure, like, if I was just a macro trader, it's like there's more uncertainty now than there was when he was just like, we're tariffing the heck out of everyone. Like, at least he knew what you kind of had,
Yeah.
and now you're like, well, where do we really stand? And I started off by saying it's the he said, she said market,
Yeah. I saw that on Twitter today.
It's like,
You said that, yeah.
It's like they can't even agree that they are even talking or not. How do you solve a problem? I don't know. I mean, we'll see, right?
Yeah, I mean, what I'm saying, it seems like a lot of countries are coming to the negotiating table, which was the whole
Yeah.
point of it, from my understanding. And I talked to Ryan Dietrich earlier in the year, and he was kind of like, you got to realize this is the art of the deal guy. He wants to make deals.
Oh my God.
That's
Yeah,
what
well,
drives him, right?
I think he wasn't expecting to have, I think it's worked in business for him. Love that for him.
Sure.
He's never had to answer to the bond market.
Oh no, absolutely. No, it's fascinating. But
I think my personal opinion is that he just turned art of the deal to fart of the deal, man.
Maybe.
Like, oh, I mean, just like the way that they have backed off, I think really almost has made things more uncertain than just, saying, yeah, we'll push it as hard as it needs to go until we, get what we need.
Sure.
My personal perspective has nothing to do with the way I'm viewing, markets right now, but
No,
it's just,
I find it entertaining. If anything, I'm just fascinated watching this play out. It's like, it's also, he's a reality TV star, right? So this is like watching reality TV, but with our money somehow.
oh man, that's it's very uncomfortably true.
True. But okay, in another context though, is I've been thinking back to 2024 and 23, where you have every average investor going, oh, look how great I am. I can just buy the index and I can make a killing. And then they're getting they're getting kicked in the teeth, and you get a market like this, and they don't know how to deal with it. How many TikTokers are like, oh, you just buy when it goes up, and
Well, I've got the best new indicator out there, which is you just buy when Donald Trump tweets that you should.
It works. I'm just saying,
apparently that's the best one.
I just find it justifies more of us who actually can understand how to manage risk in bad markets. I had a meeting with a client this week who's like, anybody can make money when the market goes up. I'm with you because I know you will not get killed when it goes down. I'm like, that's the point of me. People don't get on that until they're too late.
If markets really go down here too, I mean, like here's the deal: is like this is like a garden variety correction at this point. If the bottom's in garden variety, even if somebody hasn't played it perfectly or whatever, like everyone's within recoverable zones.
Mm-hmm.
But where you really want to see that risk management, in my opinion, is when you get into the like unrecoverable losses, which in my opinion, I think kind of the math really starts to work against you at more than a 20% drawdown.
Sure.
And that's where, like, I don't know. I mean, we do a fair amount of like financial planning at our firm and stuff. And I always look at it, I'm like, Yeah, it's easy to say you're a 30 or 40-year investor, you have this huge long time horizon, or that, you got a long time horizon, just like Warren Buffett, and you'll do it Warren Buffett's way. It's like, but Warren Buffett was selling in 23 and 24, and would have underperformed if you done the same thing, right? Like if it's early 24 and your advisor's selling your stocks off, getting you out of S&P, you're going like, well, why we're trailing the market, what are we doing here? And people have that, like, that really short time horizon mentally. we
Oh
we
yeah.
have low attention spans, and then the other thing is, like, I wasn't managing money for other people in 2008,
Mhm.
but I was around the business, like, growing up in the household I did. And life changes fast for people. Like, everything's fine until all of a sudden one day it's not. And the worst thing is that when the markets have the most severe and significant corrections, crashes, whatever you want to call them, right? The 30, 40, 50% drawdowns, like, that is when people tend to have life change the fastest. And all of a sudden, your time horizon went from 30 years to 3 weeks,
Yeah.
you know? And the devastating thing is to, if you have a sizable retirement account, and I'm not even talking millions, like, you a couple 100,000, and you're the person that makes a couple 100,000 a year. You've got a couple 100,000 or whatever in a retirement account. Like, this is the market that I tend to work in personally. And like, if you watch that get cut in half when you actually need to start tapping that, you're spending twice as much as you saved at that point. It's like less really expensive when you look at the math that way.
Sure.
And so I think it is these markets when there begins to be this significant level of uncertainty, that people that understand that on a deeper level, like, look, we can't do the absolute catastrophic drawdowns. We got to manage risk differently. They start to shine.
Yeah, absolutely. Absolutely. That's,
And
that's
whether that's a portfolio manager or an allocator or whoever it is, right? Like,
yeah.
somebody's going to need that help, because, like, I don't even think I'm that smart, and people are like, dude, I don't even know what the heck you're saying. Like, which which means,
Yep.
like, it is a way harder job, you know what I mean, than even what I do. So,
Yeah. Good
uh,
stuff.
anyways, we're past time. Hopefully that was somewhat entertaining for everyone.
Hopefully, hopefully. I was
I
going to give you one more thing on the name sentiment index, and I poked Helene Meisler, who does the weekly thing, commentary on our name sentiment index, saying they're like lower than they've been, and I'm like, I've been reporting 105. Don't look at me. I'm not the one bringing that index down.
yeah, I don't, yeah, someone must, but here's the thing about the index that, like, people always forget, is that it's just a capture of where people are at as of Wednesday at the close, right? Like, that's
Yep.
it.
Yep.
And so, if you look at Wednesday this week at the close, let's see, Wednesday at the close this week, you're like, yeah, you're in the uptrend, and the numbers started to pick up. Let's see, what was like last Wednesday? Let me see if I have, like, just a good example. This is like the 16th. Um, the 16th, right, is like, you're in that downtrend. So you had people pairing back last Wednesday, and then they're getting long this Wednesday. They missed they theoretically
Right.
missed the bottom of the low earlier this week, right? What would that be? The Monday low, right?
Mhm.
And the only reason I call that out is, like, because you could have a manager that's like 200%. And I've seen this, right? Like, there's people in name that I know report on this index, and they're just
Mhm.
they're trading a lot, and they're trading directionally.
Yeah.
And so, like, you can be like on you can go into Wednesday 200% long, but you're trading 200% short at the close on Wednesday, or vice versa.
Oh, yeah.
And
Absolutely.
it's like, I don't know, like, and I don't know what everyone reports and trades. All I'm saying is, it's like, it's so much of a snapshot that when you get in really crazy markets, I don't really know how much it is, how accurate it is, other than just a general sentiment.
Mhm.
But, like, of course, general sentiment is somewhat going to always follow the trend. And so when the trend of the market until the close today, I would say the trend of the market was structurally down.
Oh yeah, I think it
Um,
still is on a
you
bigger
know,
scale. Yeah,
so yeah, yeah, I mean, we're still below a falling 200-day moving
yep,
average. So,
exactly. So you got to play
um,
it that way.
yeah, I said that, when we got that kind of initial sell-off, I started saying like, look, this market is totally like guilty until proven innocent at this point, right? Like
Yep.
um, you started to have that rally back on what looked like it was going to be the double bottom at 5,500 key level, right?
Yep.
And it started rallying going into the April 2nd kind of announcement, and and looked like that was going to be the double bottom. So if you went back to a new high, you would say, okay, well, that was a correction, but here we go. We're kind of back, and I would have guessed that we'd grind it back to new all-time highs, but that's like some serious damage to the trend
Yeah,
has occurred. So yeah, we'll see, but bear markets have the best rallies, so
they do. They do.
take that for what it's worth.
Absolutely. Absolutely.
Okay. Well, appreciate you hopping on and chatting today, Ryan.
Happy to be here
We'll see you next weekend.
in
Costa Mesa.
Costa Mesa for names,
Yeah,
uncommon knowledge.
name uncommon knowledge. If anyone's
Be there.
watching this and you're not registered, it's not too late.
Should be there.
Great conference.
Yep.
Some fun activities. And I take time out of my week to volunteer in name, and not because name pays me, and not because I get any like explicit benefit, but because the organization as a whole and the friends that I've made in name have done so much for me personally, in helping me sharpen my skills, further my career, find new technologies, implement different ideas. Like it's just a wonderful crowd of people. And it's like an interestingly like stable crowd too. Like that it's
Yeah.
just, there's not a lot of people like coming and going. A lot of the same faces every time you show up. So you can make some really good friends. And it's kind of been a pretty fun club to be a part of.
Yep. I absolutely agree with all of that. Yeah, I would not have grown my firm as big as it has without that group. I always get something. And John McClure is actually one of the big factors. I always get something good from him that really pushes me forward every time. My biggest factors came from him.
John McClure is a bucket of wisdom for sure.
Yep. Fantastic guy.
So,
Yep.
anyways, all right. Well, let's call it a wrap. Thanks everyone for tuning in, and we'll see you guys all in Costa Mesa next week.
See you there.